It seems Aussie investors have indeed been respecting their elders. The Agri-business elders is up 57% so far in 2020, as at the 7th of July, hitting a 10-year high, outperforming its peers in the staples segment. And Elders is likely to garner even more respect as it's growing by acquisition and benefiting from weather normalisation. Elders is backed by Bell Potter as a buy. I'm Jessica Amir with Bell Direct, and today I'm joined by the CEO of Elders, Mark Allison. Mark, thanks so much for your company.
Great to be here.
So for a bit of fun, let's kick off with a 60-second elevator pitch.
Okay, so for Elders, when people think of Elders, they generally think of a big ag company, and then immediately investors think about the ups and downs of ag and how there may be inconsistent returns. So what you need to think of with Elders is a company that has a highly diversified revenue stream and geographical spread and business model, which allows us to make good money in bad seasons and great money in good seasons. And that's what you've seen. We're highly focused on return on capital, which means that all of the areas of the business must hit the previous rate of 20% return on capital, which we've had for the first two 8-point plans. And we've just adjusted that for the next 8-point plan to 15%. But clearly it drives a significant return for investors and a consistent return for investors.
And Mark, your share price looks like it's been tracking beautifully higher, with 4 of your 5 key divisions benefiting from tailwinds. Notably, the bulk of your business comes from 2 key segments. One, rural products, which sells fertilizers and farm supplies. And secondly, your agency division, selling livestock, wool and grain. Just give us a snapshot overall how business is tracking, plus where growth is likely to come from over the next year or two.
Yeah, I think that when we look at Elders, we look at it in 3-year slices. And so from being in bad bank in 2013 and 2014, we set our first 8-point plan, which took us through to the end of 2017 with significant growth. When I was chairman of Elders at the end of 2013, we announced a $500 million loss. And we said in 3 years we'd have a $60 million EBIT profit at above a 20% return on capital, and we'd be paying dividends and have no term debt. So we overachieved on all of those fronts. The middle 3 years that we're just finishing in 2020 have been around growth. And even with that growth, just to go to your question, we're still sitting at roughly 17%, so 17% market share across the various product categories. So that's a general market share, which means we've got significant area for growth. Elders this year have been around for 181 years, and we still have multiple blue chip farming areas throughout Australia where we don't have a strong position. So our blend of organic growth and bolt-on growth allows us to grow at a high return rate, so we're not forced to make any acquisitions at high costs, and it allows us to maintain a target of 5 to 10% growth through the agricultural cycles at above a 20% return on capital, which was the previous commitment, and for the next 3 years our commitment is at above 15% return on capital.
So we've touched on growth and tailwinds. Now let's move to the challenges. What are the biggest obstacles for Elders? Is the biggest the tension between Beijing and Australia, as that could impact your beef, barley and wool sales?
Yeah, I think it can be seen as a significant challenge to Australia and Australian agriculture. And throughout our history, Elders has generally run parallel with Australian agriculture, just because of our exposure to all the areas of agriculture. From a China Free Trade Agreement that was negotiated a few years ago by Andrew Robin, who was the minister, that's been moving along quite nicely. The barley issue, I think the perception of the barley issue in the metropolitan area is quite different to the reality of the barley issue. I sit on the Grain Growers Board, the grower representative organisation that actually developed the submission to counter the anti-dumping claims. In terms of the impact, that we've known about that for 18 months. There are alternative markets which have already been found. There's a discount of $30 to $40 a tonne for barley in those new markets, but everyone was aware of that 18 months ago. And so as we're coming close to the decision date, certainly from my viewpoint, I was not surprised at all and see no impact at all on our business or our producers. Those who planted barley did so in full awareness that there was a possible loss of the market in China. So I don't see that as a big issue. In the meat front, with the abattoirs that were or banned or excluded from import into China, they were excluded from import for reasons other than geopolitical reasons. So this happened in 2017, and they updated their quality assurance, and then it was reopened again. So I think the view that there are major impacts on trade with Australia through these decisions is not quite the reality. In fact, we've just, when the free trade agreement was negotiated a number of years ago, there were levels of volume of red meat or beef into China where tariffs ratcheted up further, and we've already passed 2 of those levels. So that means we're actually way ahead of the volume targets that we assumed back then. So it's positive. I think implications of China on tourism and universities is far, far greater than on Australian agriculture. And I think also that there may be a lack of full understanding that Australia's got highly diversified agricultural export markets. And, Indonesia has been a key grain market for us for many years, a dominant market. We're very strong with red meat in Northern Asia, so Japan, South Korea, and the ASEAN countries. And China is obviously a wonderful market with great opportunity, but we're not totally reliant on it from the viewpoint of export income. Critical market, no doubt. So I don't think we see the big impacts that maybe we're hearing about in the newspapers in reality.
The government has created a massive roadmap to grow the agricultural industry to $100 billion by 2030. Now, right now, the ag industry generates $60 billion per year in products. So if everything goes to plan, how will you be a part of this $40 billion in growth in 10 years and lead the industry?
Yeah, I think it's a really, really good question, because the $100 billion target, which is the next farm gate target, was initiated by the industry when we were sitting at 60 billion production, and we export 40 of that. So we use 20, or about a third, for domestic use. So since then, with the drought, we've dropped to some 45, $50 billion production. So as chair of Agri-business Australia, we work closely with the National Farmers Federation on how we achieve these targets. In fact, we're launching a State of the Industry report in 2 weeks, where I'll be talking about the gap. And the gap is around, when we look at the growth rates of each of these commodity areas of Australian agriculture, the gap is in the order of $14 to $16 billion. And we're now working with the Minister, Minister Littleproud, and all the other industry cohorts to see where we can drive benefit. One of the key issues that we need to understand, and others can play a significant role here, is around the 85% of our exports are commodities. So the idea that we can so this is beef and grain basically. So the idea that we can niche market our way to success, it just doesn't cut it, because we're actually selling big commodities which require minimum quality, timely and efficient supply chain, and best price, basically. So I think there's a lot we can do in terms of infrastructure development and streamlining supply chains. Our online initiatives are quite helpful there. And then we have the differentiated crops and animals and products. And elders, with a team of 200 agronomists across Australia, will play a key role to help the adoption of new varieties, new genetics, and better growing systems that will help drive the productivity. Productivity in Australian agriculture has been flat since about 1997. So there's a lot of work to do, and certainly elders see that they have a major role. And the fact that I'm leading this initiative in terms of filling this gap, well, we're calling it Mind the Gap. We believe across the industry, across the supply chain, we've all got a significant role to play. One of those roles in Brand Australia, which is how we position Australia as clean green, is to understand the geopolitical implications of Australia criticising customer countries that want to buy from us, and the impact that has on our brand. And so we've got a number of initiatives in place, but it's very, very exciting. Elders has a very, very important role, as do many of the other Australian ag companies. And we're excited, because if you couple that growth with our current market share of circa 17%, there's massive area for growth just by doing what we're doing. And then if you add on top of that some of the innovative bolt-on acquisition initiatives, some of the fallout from our major competitors merging, and also some of the larger acquisition opportunity like an Air, for example, I think for Elders, we see a very, very positive next 3 years.
Now, just finally, Mark, before we let you go, moving to what's next on the horizon, your earnings results for the full financial year set to be handed down in November. Now, Bell Potter is expecting great things, an uptick in earnings and an uptick in profits. Sticking with the ASX disclosure limits, what can we expect?
Well, I think that all along we've said that we will key our forecasts off ABARE rather than our own view. And, 40 years later, starting world as an agronomist and a North Queensland sugarcane and cattle guy as I am, I've always had a much more optimistic view than that. I think with the upgrade of ABARE's forecasts, it shows that it's a very positive environment. And we methodically work through servicing our clients. Ag's been an essential industry, so we've been open through the whole period. We've had border blockages and all those sort of things that happen. But from our viewpoint, it's a positive outlook. We expect by year end, as you saw at the half year, that our cash generation will strengthen, and we've particularly focused on that. The backward integration strategies are working, and I think you'll see a continuation of a very positive and focused outcome for us. And then we look forward to the next 3 years. We'll launch our third 8-point plan in November as well, when the full year results are out. And with that, my expectation is that we'll continue to deliver 5 to 10% growth through the cycles at above 15% return on capital. And in doing it in a way where you're not forced to make rash decisions or make big bets, where you can methodically and in a highly financially disciplined way continue to grow and deliver for shareholders.
Mark Allison, the CEO of Elders, thank you so much for your time and for your insights into the industry.
Thank you very much.
And thank you for watching. If you want to hear more about Elders, head over to Bell Direct's website or speak to your advisor.